Welcome, everybody. We'll get started shortly. And I know that a lot of you already know Michael, but this will be recorded for future use. And so I'm going to introduce him and get a little of his background. So Michael Shuman is an economist, attorney, author, and entrepreneur, and a leading visionary on community economics. He's an adjunct professor at Bard Business School in New York City, and he is credited with being one of the architects of the 2012 Jobs Act and dozens of state laws overhauling securities regulation of crowdfunding. He's authored, co-authored, or edited 10 books, the most recent being Put Your Money Where Your Life Is, How to Invest Locally Using Solo 401ks and Self-Directed IRAs. And we have him as our scale team consultant member for the finance working group for Food Future Western New York. So I'll turn it over to you, Michael.
Great. And I'll say just a couple things, partially for people who are in the working group for the first time, welcome. And the way that we do these working groups is within an hour, we either share some material and have discussion around it, or we do some very specific roll up your sleeves strategizing. So today, I'm going to be talking about the ABCs of crowdfunding investment, because I think it offers a lot of potential for food and farming businesses in the region. For others who are going to be watching a recording of this, I want to start really by pointing out that on our website for the Western New York Regional Food System Initiative, foodfuturewnyc.org, there is a place here where we have current offerings and we list companies that are seeking capital, food and farming businesses in the region that are seeking capital in one of three constructs. One is people doing advanced purchase of the products. The second is investment crowdfunding. And the third is donation crowdfunding. And one of the things you will know by the time I'm done presenting is the differences between investment and donation crowdfunding. So I'm going to share some slides here, and I'm going to talk probably for about 30-ish minutes, 35 minutes, and then we'll open it up for discussion. But I've called this little talk ABCs of Investment Crowdfunding, how we can help the Western New York food system to flourish. And there are many things that we are doing as a team in scale to try to support food and farming businesses in Western New York. And sometimes I think about the template that we apply to support businesses as being built around 6 Ps: planning, people, partners, purse, purchasing, and policy making. And planning means identifying gaps in the local economy, places where you are unnecessarily buying outside goods and services. And given the richness of the food system in Western New York and how much money is leaving the economy for importing foods that could very well be produced locally, that is a very significant piece of the puzzle here. People is about supporting entrepreneurs, leading, leak plugging food and farming businesses. Partners is about putting together networks of businesses that are more competitive as a team than working alone. A lot of what we're doing in this project is weaving together networks of businesses or activists. Purse is about moving savings, either short-term savings in banks or long-term savings in pension funds, into food and farming businesses. Purchasing is about spearheading buy local or think local first campaigns, and policymaking is really, I mean, it's a long list, but at a minimum, it's removing systemic biases that small businesses face. And honestly, I believe, on the basis of talking with literally hundreds of business groups all around North America, that the biggest issue that most of them face is capital, getting capital into their businesses. And I often, try to let people know when I talk about capital, just how much money is at stake. If you take numbers from the Federal Reserve in 2018, Americans had $56 trillion invested in securities. And securities are stocks, bonds, life insurance funds, pension funds, and mutual funds. And what's interesting about this is that almost all of this money is going to Wall Street. So if I was to ask you, and we won't really be able to do this in a virtual setting, but when I ask crowds, I say, so by show of hands here, how many of you are putting at least 1% of your savings into locally owned businesses? Or in this group, I might ask locally owned food and farming businesses. And the truth is there would be very few hands going up. Now, this is odd because if we were to broaden the template a little bit to local businesses in general, local businesses comprise 60 to 80% of the jobs and the output in a typical part of the US economy. In Western New York, it's probably higher because of the greater representation of rural areas. These businesses are highly competitive. These businesses actually are pretty profitable, and yet we are systematically underinvesting in local businesses, most of us not investing at all, and overinvesting in Wall Street businesses that we're kind of nervous about. The reason for this goes to law. It goes to the structure of securities law, which was put together in the US in the 1930s and 1940s. And we basically created two classes of investors. If you're Gordon Gekko, you are an accredited investor. An accredited investor is a wealthier individual as measured by income or wealth. And if you're an accredited investor, which depending on how you count it, it's probably as much as 5% of the US population, you're allowed to invest in almost anything, anytime, anywhere, few questions asked. But if you're a non-accredited investor, to put a penny into any business requires that business to do historically securities work, disclosure kinds of documents that could easily cost $25,000, $35,000, $50,000. And no business in its right mind ever wanted to do that. If we could figure out how to overcome this capital market failure, if we could figure out how to move, say, 60 to 80% of that $56 trillion from Wall Street into local businesses, it would be an additional $100,000 of capital per capita that we would be putting to use. It's really hard to think of any economic development policy that could result in so much money coming into the hands of local business. And this is why I think this topic is so important. You don't need perfection in order to get there. So this is a study that I did with two other people in 2010 called the 25% shift. And it was about food localization in the Metro Cleveland area. And what we found is that if the residents of this area shifted their consumption of food 25% from non-local to local, this would create 27,000 new jobs, nearly $1 billion in new wages, and $126 million in new tax revenues at the state and local level. To achieve that, you would need to invest in a lot more local food and farming systems. And we estimated that that would be about $750 million. Now that sounds like a lot of money, but that's this red bar on the left. $750 million is about 1% of what Clevelanders have in their bank accounts, and 1/4% of what they have in their pension funds. So really just even a modest shift of capital in Western New York could make an enormous difference to businesses on the ground and to economic vitality. So here is the first bit of good news in all of this. And this was a picture I took from the Rose Garden in in April of 2012. It was President Obama signing a piece of law that was called the Jobs Act that legalized investment crowdfunding. And the basic rules of the law were that any business could now easily raise up to $1 million. And you could do this through federally licensed online portals. And any investor, even an unaccredited investor, could put in as much as $2,200 per year into these businesses. And the ways of doing this were greatly simplified. It took until 2016 for all the regulations around crowdfunding to get put in place. But since 2016, more than 1 million Americans have done more than $1 billion of crowdfunding in businesses generally. And there's probably been about 6,000 businesses that have successfully done investment crowdfunding. The average successful investment raise for businesses doing investment crowdfunding is close to $300,000. The average investment that a grassroots investor is making in these businesses is about $800. And among the most successful businesses are those run by women and people of color. That is, those people who have been more excluded from the mainstream capital marketplace have found crowdfunding especially useful in raising capital for their businesses. Now, I want to clarify that crowdfunding comes in many different kinds of flavors. There is donation crowdfunding that you would find on Kickstarter or GoFundMe. These are not regarded as securities, and there's literally thousands of these sites that you can find on the web. There are interest-free lending sites like Kiva, and because you're not getting interest on any loans, principal is just being paid back, these are also not regarded as securities, and they are fairly unregulated. But this is what Kiva does in putting smallish amounts of money into entrepreneurs. Then there are peer-to-peer crowdfunding sites like Prosper or the Lending Club, and they are securities, and some people with businesses can use them to raise up to these days maybe $50,000. And then there is investment crowdfunding, which is what was legalized under the Jobs Act. And in investment crowdfunding, businesses can issue any kind of security: debt, equity, convertible notes, royalty arrangements. Some sites you can find things like safe notes, which is an investment in opportunities for future purchases of equity. But here's what's interesting. For most grassroots investors, as long as they get their money back, they don't really care that much about what percentage interest or dividends they're going to get. For deeper pocket, larger impact investors, they care a lot about those interest rates. The goal of local investing is really to achieve three different things. One is to get a high private rate of return. Second, to get a high social rate of return. And third, to get a manageable level of risk. So all things being equal, if you have a local versus a non-local business, the one that will definitely get you the higher social return is going to be the local business, because the local business, in spending its money locally, just like we saw in Cleveland, generates jobs, taxes, more activity that picks up the economy. But what about private returns, and what about managing of risk? So one of the problems that we have in any discourse about local investment is that we tend to think that Wall Street is much mightier than it really is. And if you listen to AM radio shows like I have for years with people like Rick Edelman, you will come to believe that Wall Street consistently is paying 10, 15, 20% per year if you leave your money in the marketplace long term. These numbers are totally made up. And the better place to look is the website of Robert Shiller, professor of Yale, author of Irrational Exuberance, and also a Nobel Prize winner. He, on his website, has data on the performance of Wall Street every month since it started. And you can see that, I mean, if you add in dividends and you take out inflation, Wall Street has achieved long-term about 8% per year. Now, you got to understand that with a couple of caveats. So the first caveat is that assumes you enter and leave the market perfectly, which almost none of us are capable of doing. Second, it assumes there's no transaction fees, but in fact, most of us are paying about 1% on our mutual fund portfolios. It also doesn't pay attention to issues of tax. At the end of your IRA or solo 401k or whatever, you're going to be taxed as you're pulling money out of it. So I think actually a better number on the rate of return is probably closer to 5%. And as a hurdle for local investment to beat, 5% is a lot more reasonable. And honestly, there are types of local investment that I think easily can beat Wall Street. We won't talk about them today, but things like getting out of credit card debt, paying student loan debt, putting money into your house, putting money into energy efficiency, investing in real estate, investing in local cooperatives. There are many, many deals out there that fall into these categories that pay well over 5% per year. But under 5% is probably where you're going to find most food and farming businesses that you'd invest in. A lot of the deals that you'll see on the investment crowdfunding sites are more in the range of 3 or 4%. Same thing with community investment funds, municipal bonds, and of course, banks pay a lot less than that right now. But here's something that gives me hope. When you look at the profitability of businesses, guess what? Local smaller businesses are more profitable than those businesses traded on Wall Street. So these are data from a not wildly dissimilar economy just north of us called Canada. And what it shows is that the highest profit rates are in those businesses with 10 to 20 employees, and the lowest profit rates are with those businesses with over 500 employees. This gives me some hope that as we develop and improve the marketplace for local securities, these superior profit rates will show in the rates of return that people are getting from investing in local smaller businesses. What about risk? If you were to approach an investment advisor today, your investment advisor, and ask, should I invest in, there turns out to be a local restaurant, it's expanding to a second location, it seems to be doing pretty well, should I invest in that? And your advisor will probably say, no, don't do that. Your advisor might say the reason not to do that is that most local businesses fail. And your advisor has now told you a very common misunderstanding in the investment discourse. When they say that most small businesses fail, what they mean to say is most small business startups fail over a 5 or 7 year period. And that there's no question about it. But I did not ask my investment advisor about a startup. I asked about a restaurant that had a good track record and was setting up for a second location. So the question was completely misunderstood. That said, your investment advisor might go on to say, look, if you're a local investor, you're going to have fewer businesses to look at, and your chance of choosing wrong is going to be greater. You also have to think about the business cycle. So every region, like Western New York, has periods of time where the region is doing well or not doing well, and it may or may not be linked to how the US economy overall is doing. And if your portfolio is made up of exclusively or mostly local securities, you're going to lose everything. And there is truth to this. But against this, something your investment advisor is likely not to mention is that there are several reasons why local businesses actually have lower risks. So one is that you can get better information about companies. You have an ability to actually test out the good or the service of the company you're thinking about supporting and talking to the entrepreneur or talking to the workforce, basically ground truthing the whole thing to prevent yourself from being defrauded. Second thing is, as I mentioned earlier, you get a social rate of return on top of your private rate of return. That actually helps to bring down your level of risk. And then third is that the investors in local businesses turn out to be not only investors, they also turn out to be evangelists. That is, I mean, if you think about it, if you invest in your local co-op, you're going to do a lot more of your shopping there. So you're not just an investor, you're a shopper because you get benefits from shopping there a lot. You also might be a great marketer in convincing friends and neighbors to shop at that co-op. What about finding local investments? Well, there's a lot of ways of doing it. Talking with fellow travelers, talking with people in sort of the business support universe. A lot of the people in this working group are people in the know of what businesses might be looking for capital. But another way of doing it is to form a group. And it's worth mentioning the history of a group in Port Townsend, Washington called LION. LION is called the Local Investment Opportunity Network. It was set up by the guy on the right in 2007. He was a former hedge fund manager, and he came back to his hometown in Port Townsend. Port Townsend's a town of about 10,000 people, 2 hours north of Seattle. And he started to put together a potluck dinner. Once a month, at this potluck dinner, he would invite local businesses and local investors and just encourage them to form relationships with one another. He did no transactions. There was no discussion of transactions per se. It was all purely social. But just this one social invention in a town of 10,000 people has led to $1 million of new investment per year in local businesses in Port Townsend, mostly food and farming businesses. In Baltimore, a colleague and I set up a very crude website that we call the Maryland Neighborhood Exchange about 3 years ago. And the Maryland Neighborhood Exchange lists all of the businesses, local businesses in and around Baltimore that are looking for capital and crowdfunding. So if you live in Baltimore, you know to come to the Maryland Exchange and you can see the freshest list of plausible local businesses to invest in. The history over the last 18 months has been extraordinary. We basically have helped 44 businesses in Baltimore, mostly run by BIPOC entrepreneurs, raise over $3 million from 6,000 investors. And again, all of this was done in a really quite crude website. So all of this is to explain that one of the rationales for creating this space in our project website is to get people familiar with, if you're interested, if you're a business and want to raise capital, get into one of these slipstreams for investment crowdfunding and list your company in our website, and we're going to try to grow audience there. And if you're an investor and interested in local food and farming businesses, come to that part of the site regularly and see what's listed there. And there are other sites out there that can help you find local businesses. This is called investibule.co. That at least you can go by state or by food business to find a sublist of potentially interesting businesses to do investing in. What about evaluation? How do you evaluate local businesses? Well, one of the things that is different about local investing is that as a grassroots person, you have to actually do some work. You can't just go to a Yahoo Finance page and see, this is what the riskiness is, or this is what the returns are. You really have to do some research. And again, this is why having a group is so important. Another thing that you'll want to do is think about liquidity. Now, liquidity is all about, how quickly do I need to turn this investment into cash? So if you're giving a short-term loan to a business, it'll become cash pretty quickly. It's not an issue. But if it's paying you back over 10 years, it could be an issue. And if you're buying, say, stock or a safe note, it may be a long time before there is a plausible way of your converting that back to cash. So you need to think about that. And I think it's very important for people to sort of compare their own risk profiles with the securities they're looking at. What are their needs for liquidity? What is their ability to absorb risk? And that's part of how you look at local investments. Another problem that sort of stands as an obstacle for local investment is that to the extent that most of us have any investable savings at all, it's in our workplace 401ks or in our IRAs, investment retirement accounts. And these are, of course, places where you can put money and deduct that from your taxes. And then when you pull money out, you pay taxes on it later when you're retired. The problem is that most of the systems for investing 401ks and investing IRAs have zero ability to invest locally. But there are ways of doing this. And the two kinds of secret weapons of local investors are the self-directed IRA and the solo 401k. So with the self-directed IRA, you can go out, hire a custodian from one of maybe 200 companies. If you shop around, say at Rocket Dollar, you could do this for as little as $250 per year. And then you just instruct your custodian, I would like my tax deferred account invested in this local business or this local project. With a solo 401k, this is for self-employed people. And with this, you buy or rent a prototype, what's called a prototype, from a law firm. And there's about 50 companies out there that will rent you these prototypes. You have to pay one fee over a 6-year period. It's just $300 again at Rocket Dollar. And there are several advantages to a solo 401k that I'll mention in a minute. But again, as a requirement for a solo 401k, your income has to be reported on your Schedule C as business income. Now, you can have a day job and a night job where you're reporting the Schedule C income, and that Schedule C income can go into your solo 401k. You also can't have any full-time employees, which are defined as an employee working 20 hours a week or more. The advantages of the solo 401k are really several-fold. One is it's cheaper. Second is you can run the investments out of your own bank account. The third is that the amount in theory you can contribute is significantly higher. So with a self-directed IRA, you can put in, like a normal IRA, maybe $6,000, $7,000 per year. With a solo 401k, there are strategies for you're putting in as much as $120,000 per year. So if you're self-employed and you have a really good year, this is what you need to do to hide your money from the tax man and get involved in the local investment universe. Another thing that you can do with a solo 401k that you can't do with a self-directed IRA is you can give yourself a loan of up to $50,000 or 50% of what's in your account, whichever is less. That gives you the power to do a wide range of investments that you can't do out of your self-directed IRA. In my view, the magic formula is that, as soon as humanly possible, you want to set up a solo 401k, even if it means you're doing it on the basis of $1 of income from selling an item on eBay. And then when you leave your workplace, leave it because you're retiring or you've been fired or you're moving to another job, you then have access to roll over your 401k into your solo 401k, and you're off to the races being a local investor. Just a quick word or two about if you're a business. If you're a business thinking about crowdfunding, there's a lot of things that you want to think about before you do this. So the first is questions about, what your business can tolerate. If, for example, you're borrowing money from the crowd How do you feel about taking on more debt in your business? If you have a lot of people who are invested in your company, that's a lot of people to answer to, and it might be a bit of an administrative headache. Another question is how ready are you for outside investment? Probably it helps if you have actual sales already, that you're not a hypothetical business. It helps if you have a solid growth plan. It helps if you have a great board that people recognize in the region. And in terms of just readiness for crowdfunding, one of the things you'll want is a fan base. Now, I know lots of success stories on the Maryland Neighborhood Exchange where just having a fan base of a couple of hundred people easily allowed a company to raise $10,000 to $50,000. But if you want to raise a couple of $100,000, or now the SEC allows you to raise not just $1 million, but up to $5 million, you're going to need a much larger list to work from. Another thing is, are your books in order? The crowdfunding sites really require certain kinds of bookkeeping having been done in the last 2 years. We can talk about that if anyone's interested. And finally, what is your capability of marketing your securities to the crowd? Some people have great social media plans and activities out there, other people don't. In terms of next steps, I mean, I'll just say a couple of things. One is, in a couple of weeks in this group, I'm going to take 3 entrepreneurs through a series of questions to help illuminate whether they're good candidates for crowdfunding. So if you're coming to this through a videotape, I encourage you to watch that videotape as well. If you want to just come live for that, I think it'll be a fun session we're going to have. I also do these deeper dive courses. I've done them for state networks of businesses. I'm about to do one for Washington State in April, but I've done them for Alaska and Rhode Island and New Hampshire and Vermont. And really, you know, we go through a lot of this stuff in 4 classes and have a bunch of videotapes that people can watch that answer all of the questions they tend to have about local investing. So let me stop there and open it up for questions or discussion.
Thanks, Michael. I think you really made me think a lot about how it's kind of like a domino effect, and we just have to get the ball rolling in the region. And I guess I wonder if there's any major groups that you think would be good to target in terms of us trying to spread this message and trying to make that transition.
Yeah, I mean, I think there are several different groups. I mean, some of them are represented already on the RAC, the advisory committees. But I also think, and this is, so when I come to the region in 3rd week of May, what we're going to be targeting is chambers of commerce, economic development groups in the counties, and other kinds of business associations. And whatever group wants to kind of, get a little introductory session, I'm hoping to share this with them and answer questions and just encourage people to come into the system.
Hey, Michael, what are the mechanisms set up to provide some due diligence, beyond beyond individual consumers interacting with the potential companies they might invest in. One of the things that certainly normal investment vehicles has, there's no guarantee of return, but there is at least some semblance of due diligence in evaluating the soundness of these businesses.
Right. So there's a couple of answers to that question. One thing I encourage you to do is go on to any of the well-established portals for investment crowdfunding. I like WeFunder. It's a pretty good one, and a fairly high percentage of the transactions are done there. But there's 80 of these portals right now, and they all have to meet a checklist of requirements that the SEC has given to them. And the checklist has a bit of a balancing act going on. On the one hand, they want the portal to do some degree of due diligence before they put a business online. So they will do checks, criminal and credit checks on members of a business board. There's a certain, depending on how much money you're asking for, you may have to get statements from accountants about your books. You may, if you're asking for a very large amount of money, you may even have to get an audit. They also will encourage you to post in a fairly structured way where your business is heading and statistics about your business. But, and this is the other side of the balance, the SEC doesn't want them playing favorites. It doesn't want them saying, well, we like this business more than that business. They're not in the business. I mean, once a business sort of reaches the checklist, they are obligated to put them online. One of the things that happens through the portals, though, is that the conversations between the business and potential investors is structured in a basically a glorified bulletin board that's on these sites. And the SEC insists that it be structured in certain ways. And that way you're not, the company is, whatever representations it's making, whatever ways it's answering questions, that information is basically publicly available to all of the potential investors who might get that security. The good news is that, so far, knock wood, there has not been in 5 years any major scandal of these 6,000 companies. There certainly have been failures, and that's to be expected with the terrain. But I think that the requirements around due diligence have been adequate to protect most of the small investors. And that's the other thing to I think underscore here, is that the SEC was convinced when it enacted these laws that the old way of protecting small investors, which was to say, unless there is $50,000 of legal work, you can't put in a penny, that wasn't going to cut it anymore. So what they decided is maybe a better system, a smarter system, is just to limit the amount of exposure that any individual could have in the crowdfunding universe. So it's still limited to $2,200 per person. And that pretty much protects people from losing their life savings in this practice. One of the, I'll just throw a question out there for others here, is that, we are looking right now for other examples of companies in Western New York who we think might be good candidates to think about crowdfunding. Because I feel like having a few good examples out there will be pretty inspiring to others. So, if you think of any, and I know many of you are working with networks of these businesses in your day jobs, please let us know. And, I'll have a deeper dive conversation with whoever you bring to us. So Max, you had some businesses that you thought might be plausible candidates for this.
Yeah, there was a business that I met with last week, but I wasn't sure if they were looking for any kind of funding. They're looking to entirely self-fund. But I will, as I continue meeting with new clients, try to see if I can find someone who would be a good fit.
Great. And Purnima, you also have a bunch of businesses that you're trying to help raise capital from time to time.
Yes, so I did speak with the West Side Bazaar manager, and I'm going to be speaking with the relationship managers. I've also spoken with Providence Farm Collective. Unfortunately, Beth couldn't attend today, but I'll be sending the recording to her, and hopefully in the next week or so, we'll have at least one, if not two, for the panel on April 16th.
Wonderful, wonderful. Okay. And Laura, what about your universe? Laura's new with us. Maybe you even take a second to introduce yourselves to others in the call.
Hi, I'm Laura Scondras, and I'm the farm loan manager for the Farm Service Agency, which is USDA. We provide federal funding for farm loans. We have operating type loans and farm ownership loans. And basically, most of our customers are ones who can't get financing with a regular commercial bank. So a lot of times startups are included, or if somebody's had something that they had issues. We are supervised credit, so we do assist with record keeping, different kinds of things to help counsel them too, and then direct them in as far as like extension or FarmNet or other agencies to work with. So basically, we're all basically loan based. I mean, we do have, when you work with us, you work with our other agency that does have not grants, but our farmers sign up and they have different programs there that aren't loans, and sometimes they can get money there. But basically we're a loan. And it's all federally funded.
Right. And have you had businesses that before they've come to you for loans have done some crowdfunding, or do you think of it more as following an opposite order, that first they should do loans through you, get some experience under their belt, and then maybe go to the crowdfunding marketplace?
I think that crowdfunding would be great because a lot of times, we do hope that they have at least 1 year or some sort of operating managerial type experience. But our farm ownership program does require that they have 3 years. We can substitute education or, as far as being a veteran or something. But so a lot of times I can't get these people finance because they want to start up and the first thing they want to do is buy real estate. And if there's some other way that they can start their operation and either lease the facility or at least do it on a smaller scale to get that 3 years, that is ideal.
Yeah.
So that is something that would work well.
Yeah. So one thing I should mention is that you can see a couple of trends in the crowdfunding space. And one of the trends that I've noticed in the last year and a half or so is from business to real estate. You see a lot more real estate deals. And I think part of it is that investors, rightly or wrongly, perceive a real estate investment as lower risk than investing in an early stage company. But yeah, I mean, it may be, I don't know, maybe there's a way of helping with some of these real estate kinds of purchases that these companies want to do through the crowdfunding. I would check out, there's a couple of sites out there that focus on real estate. And my favorite is called Small Change. So just check out that site. All right. No other questions or comments before we wrap up? People want to go outdoors and enjoy the springtime. I appreciate that. Okay. Well, we will create a recording of this available for folks who want to share it. And thank you all for coming. Appreciate your being here and your interest in the topic. And we will see you, some of you, in 2 weeks.
Thanks, Michael. Thank you, everyone, for coming.
Okay.
Thank you.
Thanks for inviting me.